So welcome everyone to our first timely topic event, which will focus on the mid-year economic outlook. We are thankful that you have chosen to be here today to learn more about this timely topic. I would like to start off by introducing our presenters. Please welcome Dr. Stephen Mohler. With a background of more than 30 years in finance and marketing roles in industry, Dr. Mohler joined the IUPUC faculty as a visiting assistant professor in 2017 to lead our strategy, management, and economics courses. Following completion of his Doctor of Business Administration degree in 2019, Mohler's research interests have focused on strategy, marketing, social media, and small to medium enterprises. Mohler also has a keen interest in contemporary economic issues and enjoys being a Fed watcher. Please also welcome Dr. Ryan Brewer. Dr. Brewer is an associate professor of finance at Indiana University, Columbus, where he's worked since 2009. As of 2018, Dr. Brewer serves as a director of the IUMBA Columbus. Dr. Brewer earned his PhD from Indiana University Bloomington in 2011 on the topic of financial economics, intrinsic valuation. Prior to entering professional school, Brewer worked for 5 years as a risk manager for a Fortune 50 corporation in Michigan and Indiana, ultimately attaining worldwide responsibilities for the development of policy compliance programs. Before we get started, we have a few quick reminders for our event today. We ask that all participants remain muted with their video off for the event until we get to the question and answer session. Also, please send questions through the chat function of Zoom for the 15-minute facilitated Q&A session at the end of this event. We will now turn the event over to our presenters.
Thank you, Frank. And I want to just say thank you to everybody. Thank you to Kate for setting this up, and thank you to the participants, Frank and Dr. Mohler, for joining in this. So I'm going to start us off by kind of giving a big picture of the economy in the pandemic. So while we're working through technology here, this is kind of fun. Now, Steve, can we see, am I sharing the screen successfully? Yes. All right, thank you. So what we've got is a pandemic, obviously. And so the question is, how do we make sense of it within businesses, with personal finance decisions and things of that nature? So I'll start off with kind of a big picture summary and maybe put Columbus, Indiana in a little bit of context. Then I'll turn it over to Dr. Mohler, and he will hit home a little bit more from a local and a regional perspective, and then we'll open it up to questions. All right. So my presentation is going to start off with coverage of employment conditions, output, sentiment and savings, the bond market, how Cummins is doing, international contrast, equity markets, risks, and then we'll turn it over to Steve at that point. So employment. Okay, so what we see here is things were fine in the United States March 1st, but during the month of April, later part of March and during the month of April, we saw unemployment rates spike, 17 million by April 25th. By May 16th, there were 22.7 million unemployed in the United States. It's come down since then. In the last reading, it's still in the high teens as far as we know. Although the data is coming fast and furious, it's hard to collect. So in terms of indicators that predict recession or predict down output in the future, initial unemployment claims are an important factor. So if we go back into here, and Steve, can you see my cursor on that screen as I move it around? Okay, good deal. So as we go back into the pre-pandemic situation, we had a couple 100,000 initial unemployment claims per week on like an ongoing basis that just, we were really doing well with a super tight labor market. And then all of a sudden, just like an asteroid hitting the earth in the day of the dinosaurs, we get this pandemic and initial unemployment claims spike all the way up to 7 million for 1 week. And they came down, and during the month of April and maybe into May, I think people started to think, okay, we're going to be all right. We're going to get out of this thing. Maybe by July 4th, we'll be back to normal. They're going to fast track a vaccine. Everybody will have it before the school year starts. And then we just sort of flatlined here where we've got about 1.2 million or 1.25 million unemployment claims every week, new claims every week. And that's where we are. So we've stopped declining in the new claims. And what we've also seen here is the unemployment has sustained around that 17 million number. So we came down from the 22, but we haven't fully recovered and we're not even close. So how does Indiana compare to the rest of the country? This is not a very good chart in as much as it's hard to see. You'll have to squint and get close to your screen. I'm sorry about that. But Indiana is a little bit better than most. We've lost about 7% of our jobs, not nearly as bad as the East Coast states, as well as Michigan, Wisconsin, Ohio are worse off than us. Illinois is worse off than us. Arizona's better than we are, but we're kind of in the middle, maybe not as bad as some in terms of total numbers of jobs lost and still lost right now. Within Indiana, Columbus sits kind of in the middle. There are places that are better, like our peers over in Bloomington, down in Evansville and Kokomo, and then there are places that are worse, such as the cities up in northern Indiana near South Bend and the environs around that area. So looking at the Columbus, Indiana employment, we've got the civilian labor force here, and then the number of employees here, and the number of unemployed here. And what we see is in January of 2020, the number of unemployed were about 1,200, 1,100 in February, 1,000 in March, and then all of a sudden in April, it spiked up to 7,600. So again, this was a serious shock to the economy, the likes of which we've never seen before. So unemployment spiked up to 17%. It's come down to 10.6 as of the last count, which is only through June. We don't have July numbers yet. Steve, correct me if I'm wrong on that, but I think we're just through June on that. So Indiana's at 11.2% unemployment. Columbus and Indy are both at 10.6. Kokomo's the high in the state that I saw, 16.8% still. Kentucky, interestingly, is low. It's got 4.8%. Louisville at 6.4%, and the rest of the state lower. For instance, Lexington at 4.2%. These are at the last count for unemployment. Other places doing well. Idaho is doing well, 5.3%. Idaho Falls at 3.6%. Illinois, not so good, 14.6%, with Chicago at 15.6%. And some other cities around the country, we see sort of a pattern begin to emerge. We've got Atlantic City, Ocean City, Las Vegas, a town in Hawaii, and Orlando, all with also a town in California, all with very high unemployment rates or vacation destinations, struggling with hotels, struggling with airfare. They're suffering. A lot of people in the getaway industry that are unemployed and remain unemployed right now. Also, Massachusetts would fall into that camp as well. And we've also got places like Detroit that are industrial cities, much like South Bend, Indiana, that are also suffering right now as well, with still remaining high unemployment rates. Gainesville, Florida at 5.9. Again, some other places where the economy hasn't really been rippled through. I think another component is retirement areas where retirees maybe haven't really had to alter their behavior too much. So their expenditure patterns and income patterns are roughly the same before and after the pandemic. Not always true, but definitely less affected. So another context to put things in perspective, the red line is the current pandemic, going back to September of 2019. This is 3 different recessions. Blue is 91, for those of you that can remember back to that. Probably not many of you. And then the orange one is 2009, the Great Recession, and the red one is the current one. So you can just see the dip is a lot more severe and a lot deeper in terms of how much unemployment and dislocation in the economy that this current pandemic has caused. So, well, I'll get back to this for a second. The annual decline, annualized Q2 decline through 32.9% last quarter is the worst perhaps ever, but at least since 1947. We actually dipped down 9.5% in the quarter. So we believe quarters 3 and 4 are going to be less terrible than that. So we're going to have drops in total output in all likelihood, but they won't be as bad as they were in Q2. So overall, the forecast, I guess if I'm perhaps unwise enough to provide a forecast, would be that during the calendar year, we're going to be somewhere between 5 and 15% off of 2019 levels. And that's as good as we can do right now. And of course, I'll turn it over to Steve and he'll give you what he thinks as well. But in other words, Q2, I think most people agree, is probably the rough spot. Of course, many factors are going to play a part of where we end up. There are a lot of political factors. There's some biological factors that we're going to have to deal with, and the extent to which how we get through this new school year, which is starting right now. A lot of schools may be perceiving or having trouble with how they're handling coronavirus transmission. And given that we either do or don't get through this with easily, is going to determine a lot in terms of how Q3 and 4 turn out in 2020. Another indicator for the future is consumer sentiment. And as you can see, it started falling off in March. By April, it's been down and has stayed down. We got a little bit of optimism in June, but that was quickly taken away. So we're back to kind of check and wait and see how the coronavirus is going to come out. Another indicator that things aren't doing too well is that we're saving more money. We, in my opinion, have always been chastising people. I'm a finance professor, so I'm always telling people debt is a 4-letter word, save your money. So guess what? We're doing it now. Americans are saving their money. 32.2% as of June. In July, it dipped down to 23%. That's still a good number for Americans. We contrast that with the Chinese. China has always saved their money wisely. They're up in the 38 to 40 percentile. It's coming down. And the reason why I'm looking at this is it gives people context and perspective in terms of how much they trust their own economy. When the economy's strong and the people of an economy believe that the economy will continue to provide for them and they can be an active participant in that successful economy, then people don't need to save a whole lot of money because they know that their jobs are reasonably secure. And if it's not, they can go get another job relatively easily. So in China, they haven't felt that way. So they've saved a lot of money when they've had a job, but that's getting better. You can see that their confidence in their own economy has been improving. Now, of course, that's probably closed off a little bit here recently around that 34% number as well. So they're still saving a third of their income as they fight through this pandemic as well. Another indicator to look toward to see what's going to happen in the future is bonds activity. And so the interesting piece of this chart are these gray vertical lines indicate recession. And for the last 7 or 8 recessions, they've been preceded by what we call an inverted yield curve, where the short end of the bond structure gets more expensive than the long end of the bond structure. In other words, you're not going to get as big of a return for investing your money with a longer restriction lockup period. That doesn't make any sense. And every time it happens, we end up with a recession shortly thereafter. So what that's saying is when the bond structure gets inverted like that, it's really, really causing people to flight to safety with their investments. They're pulling money out of equities or pulling money out of risky assets because they see the storm is coming. And that's what happened again. Now, this time, I don't know if it was fortuitous or coincidence, because we had an inverted yield curve in September last year, but then we had a pandemic that really launched us into this recession. So I don't think the yield curve inversion can take credit for the coronavirus. Over the long haul, bonds have gone down in terms of their yield for decades. And what that's done is throughout really the 90s, the Clinton years, the George W. Bush years, and the Barack Obama years, as well as now, have really put more emphasis on equity investments. Stock investments have been a more and more attractive alternative as bonds return less and less over time. And you can see that trend is continuing. And now, my understanding is mortgage rates are at their lowest level, perhaps of all time. We've got 30-year mortgages for less than 3%, for instance, and there's a lot of other bond instruments that the yields are so low, it's just never been seen before. However, importantly, we do not have an inverted yield curve right now. So now my next topic is Cummins. How is Cummins doing? And of course, just like everybody else, in terms of revenue and earnings, are not doing too well. The change in the second quarter from 19 to 20 was down 38%, gross margin down 46%, with net income down 59%. They declined in North America. That was the big hurt right there, 48%. International sales only declined by 22%. So lesser of two evils, the international sales has really helped Cummins weather this storm. The strong dollar, however, for international sales didn't help them. That hurt by about 2% equivalent. Engines were down 47, along with components at 38. Distribution only down 21. That's helped as well. And power systems down 35. Also, because of the continuing uncertainty, Cummins wisely will not give guidance for the third quarter, along with a lot of other companies in the Fortune 500. So the stock price has been really well, though, done really well. So we look at the total return since the pandemic measured to March 19th. They've had a 65.25% total return since that time. The 52-week total return is 32.5%. Those are fantastic numbers for the non-investment gurus among us. I'd take that all day. Their recommendation from the analysts is a hold or a buy, with most people saying hold and then the next most saying buy. So Cummins stock is doing well. To do a little comparison with CAT, we can see that their sales were only off 30.7%, and that's largely due to their heavier reliance on international sales. But their net income was down almost 72%, which means they weren't as efficient at dealing with the variable and fixed cost mix compared to Cummins, because they only down 31% with sales. Cummins was down 38, but they're off almost 72%, Caterpillar, so not as good. And consequently, they've only got a total return of 43%. Now, I wouldn't be upset with that, but that's not the 65% we saw from our neighbors here in Columbus. Also rated as a hold buy. So what's going on in international activity? It looks like it's been helping our industrial compatriot Cummins. And so what's been happening is the recovery over there has been largely based on infrastructure stimulus. They've expanded GDP in the second quarter by 3.2%. Remember, they survived the coronavirus in late 2019 and January of 2020. So their GDP shrank in the first quarter by almost 7%. Restaurants, hotels, non-essential goods and services remain muted in China, and the production recovery was much better than the demand recovery. They're still tentative, going out to eat, going to hotels, doing service activities in China. They're still not doing that as much as they once were. Additionally, that 3.2% in the second quarter was probably plugged a little bit by cheap commodities, which China used to do infrastructure activities. So while their retail sales were leading industrial production before the pandemic, now in China, industrial production is leading retail sales. So again, they've come back, they're back to work, they're being productive again, and they're very efficient, but they're not buying as many things in the retail market. So how are the equity markets doing in general? Well, the equity markets have been doing really well, as we know. And you know, it's interesting because the economy has suffered much more than the equity markets would suggest. And I think the reason for that is twofold. One, the equity markets are a future-oriented teller of what's going to happen in the economy. So the equity markets believe that the economy will recover in time. And I think it was based on that downward track in initial unemployment claims that never really finished its track. So we'll see what happens in the future. A lot of people think it's overheated. 84% of reports beat expectations, and that's a record for all time. So corporate reports on earnings, 84% of the time beat analyst expectations. Earnings declined, average between 36 and 42%, which sounds like a lot, but they were expecting worse declines than that. Revenue declines were expected to be between 9.6 and 10%. They, again, were expected to be worse than that. Leading industries are industrials, consumer discretionary, of course, led by Amazon, materials, and healthcare, of course, with all the pharma and biotech. The lagging industries are utilities and energy because there just haven't been that much activity. People are staying home, people aren't driving as much. Steve will talk about more of that in the future here in a moment. But those are the two industries that have been lagging. So with respect to the equities markets, because there's such volatility and uncertainty right now during the recovery of this pandemic, only 32 of the S&P 500 are actually offering future guidance for the third and fourth quarters. 51 firms were going to, and they withdrew their opportunity to do that. So that means out of 500 S&P public firms, only 32 are offering guidance. Now of the 32, 25 are offering positive guidance, 7 are offering negative. So ultimately, quarters 3 and 4 are expected to see declines in revenues and earnings, but not as bad as what we saw in the second quarter. So what are the risks right now that we face as an economy going forward? Well, I think we can all agree that we have political and leadership risks. Do we have a coordinated plan? What's going on? Quasi-shutdowns or shutdowns into the fall and winter, such as what's going to happen in the schools, could pose a problem to the economy. We could see that W-shaped double dip if that doesn't go well. A lack of loans forgiveness. We're talking about Congress getting together right now and attempting to extend the fiscal stimulus. So loans forgiveness is part of that, as well as extended financial assistance to people that need it, the unemployed and the underemployed, as well as the Fed continuing to do its job and providing continued liquidity in the banks, which they've done a great job of doing. Certainly a lot better this time than the Great Recession of 2008. Another concern right now is question about PPP loans and another extension, another armament for small businesses that are in need of liquidity. Because if we do end up with a W on the economic side, if we do end up with another shift in unemployment, it could cascade into a domino effect and we could have a second economic shock. So I hope Congress is listening, and I hope they understand that small businesses need a lifeline right now. We also have issues resurfacing trade friction between the US and China. In case we didn't have enough to deal with, let's throw some trade friction on that as well. And then finally, everybody understands these last two things. There's so much uncertainty with respect to when we're going to get a vaccine. I know Dr. Wadsworth and I have talked about this, and we don't know of a time in human history when people have got together under any circumstance and developed a vaccine or an effective therapeutic in less than several years for something like this. Like coronaviruses have been around for a long time, influenza viruses, cold viruses, and we have had trouble biologically developing vaccines and therapeutics to fight these things. These things are smart and they're small and they're capable of mutating. So I think we might be in this for the long haul, and we're going to have to do this as a society together. So if we don't get together and handle this new normal well, that's also another risk to the economy in terms of how we're going to go forward and be productive in the midst of the coronavirus. So those are the big picture items that I had. And at this point, I will stop my screen share and turn it over to Steve for some additional comments about Columbus and the Columbus economy.
Thank you, Dr. Brewer. As Ryan has alluded to, there are a lot of sensational news articles out there. GDP down, vehicle sales decline, 47%, a spike in unemployment. We didn't even see 14.7% during the Great Recession, and 54 million people file initial jobless claims in a few-month period. Shocking. Shocking. There's also been a lot of discussion regarding U-shaped recovery, V-shaped recovery. Ryan just talked about a W-shaped recovery. And kind of, what is that besides alphabet soup? All right. Where I want to begin is the consumer segment is the largest segment of our GDP. Of that, retail and food sales are an important component, obviously. When we look here, this is the first 6 months of this year, and you'll notice that contrary to the projection in January of an increase of 3.4%, total retail and food sales was down 3.4%. Of particular note, gas stations down 17% because miles driven was less. It was down 6.5%, which took us back to a 2007 level. Food service and drinking places were closed, so they were down in the first 6 months almost 23%. However, you all shopped online, and that's why non-retailers, e-commerce was up. So some bright news in the overall plan. Included in those retail sales numbers are this information, new vehicle sales. Surprisingly, for the last 5 or 6 years, we've cruised along, the United States, selling an annual rate of 17 million vehicles. And then April happened, and then coronavirus happened. The second column has total vehicle sales. And you'll notice April last year, they sold 1.4 million vehicles. April this year, 745,000, a pretty stark drop. Fortunately, the auto manufacturers were watching, paying attention, and essentially shut their factories down as well. So inventories didn't get out of control like they have in previous recessions. So for the vehicle sales, we may be okay at this point. Projections are that it will be at a lower level this year, maybe 15 million annual rate, 14.5 to 15, and possibly back up to the 17 million rate next year. Good news for Columbus, we are so tied into the auto industry. Moving to another area, single family housing. If you look here, you will notice that single family housing in our area, Bartholomew, Decatur, Jackson, Jennings, Shelby, Indianapolis, for 19 and 20, 18, 19, and 20 has shown a slight decline. So part of that is due to inventories of homes available for sale. Part of it, obviously, for the economy, but if you look in 2020, it hasn't fallen apart. Good information on this page, building permits, Cincinnati and Indianapolis are up this year, which tells us construction of new homes should be higher. Building permits in Columbus about equal with last year. So we're not seeing a drop off in housing like we did from the Great Recession. People are buying, people are anxious to get out and buy. Moving back to a little information that Ryan portrayed, and I'm giving it to you in a little different fashion. You'll notice that in the second quarter, the 33% drop in US GDP, that was right after a 5% drop in the first quarter. The reason I don't provide you information for the metropolitan areas in GDP for the most recent periods, they don't supply it. They're always about a year, year and a half out. What I do want you to pay attention to is when you look down here at the components of GDP, Indiana is a heavy manufacturing state. We're at almost 30% compared to 20% for the country. Durable goods, 17% compared to 10% for the country. Now look at the Columbus column. Almost 40% of the Columbus GDP comes from manufacturing and durable goods. We are tied to Cummins. We are tied to the automotive industry. Glad to see that they don't have a lot of inventory and hopefully will rebound quickly. Hopefully. Unemployment rate, 14.7 was this big spike, and you'll notice Louisville, Columbus, Greensburg, North Vernon, Seymour, Shelbyville, we all experienced it at a higher level. On the positive side, Columbus and Indiana have rebounded quicker than the nation as a whole. Ryan mentioned Louisville, and that's going to take a whole lot more review to find out how they bounce back so quickly. But we still have a few areas that are below the national average. Because hospitality and leisure have been highlighted several times in the press and by Ryan, I dropped in here. Hospitality and leisure went down 27% for the nation. It went down 36% for Columbus. Fairly significant. And how quickly that will rebound, we'll have to see. Changes in employment. Again, big numbers in April. We expected that. But you'll notice some pretty good recovery in a lot of areas after that. Indianapolis brought back 120,000 of the 149 so far. Columbus brought back 4,000 of the 7,500. So we're seeing some recovery in employment. What we have to consider overall, and Ryan pointed to a few of these as well, Congress and the stimulus. Will there be a stimulus bill this year? My guess is it's an election year, yes. What will that be? How much will that help? That's the real question. How much money will it put in the pockets of consumers? We'll see. The Federal Reserve, as Ryan indicated, has been pumping liquidity into the markets at a lot higher rate originally than the Great Recession. At this point, the Federal Reserve is putting in $80 billion a month in liquidity. That is comparable to the height of what they were putting in during the Great Recession. That's well over $1 trillion a year in money supply to keep the markets from locking up. However, Ryan did present to you consumer sentiment. Before this year, it peaked out at about 100. Right now, it sits at 72. So consumers are concerned, and we're seeing that in savings rates. But consumers being concerned, consumers may not spend. That's a definite issue for the overall GDP. Income, well, if Congress doesn't act, there's going to be a lot of people without income. People have already lost the $600 per week unemployment benefit that was part of the original bill. That ended the end of July. So we're talking not being able to pay rent. We're talking not being able to buy groceries. A lot of people are going to be struggling if Congress doesn't act. The savings rate increase is good news. As Congress spends more and more money and runs up more and more debt, they need money, somebody to borrow from. Apparently, it's going to be us. We're saving more, and that will give Congress money to borrow. But as consumers save more, they spend less. Again, consumers drive the economy. That's going to have a negative influence. I mentioned miles driven earlier. That has a lot of repercussions for the Columbus community, since we're so heavily tied into transportation and automotive. If they drive less, do they need to replace their vehicle less? They obviously buy less gas. All the services supporting commuting are impacted. So there's a positive to it. It's good for the environment, but it's not so good for the economy overall. As they work remotely, drive less, that has implications for business, less people in the office, possibly less need for office space. I haven't seen that occur yet, but we're still early in this work at home situation, even though several companies have indicated that they're going to work from home for the rest of this year. Commercial space may become more and more empty as people work from home, as business formation or business closures accelerate. Business formation in the first quarter of this year was equal to the previous quarters. We haven't seen it for the second quarter, and I think there'll be some surprising statistics there. Business closures are even a little farther behind in being reported, but with all the food and beverage businesses struggling at this point, if we continue on the path we're on now, we would expect this churn between formation and closure to move towards the negative side, and that obviously will have dire ramifications for the GDP. One final issue, this health issue. We talk about it in the state of Indiana, we talk about it by state, we talk about it by nation. This is a global issue. And I heard a commentator speak on it recently that if we get it under control in the United States and international travel happens, it may come right back. Remember, the Spanish flu lasted from 1918 to 1920. And we're anticipating, or we're hoping at this time that this pandemic will be over before the elections, which may be kind of a Pollyannic view. This may continue for a while, and business has to adjust. So with that, I would like to open it for any questions you may have. Ryan and I will be glad to address them to the best of our ability.
And if you don't, thank you, Steve, I appreciate that. If you don't want to talk your question, you can feel free to go to the bottom of your screen and type your question into the chat box, and we can address the questions either way.
I've got one question for you. Relationship with the European Union is souring quickly, and certainly the pullout of the troops in Germany is not going to help that relationship at all. So what impact, if this relationship continues to sour, will that have on the U.S. economy?
We've already seen some impact just from the pandemic, because exports are down. Imports are as well, but exports are down. So, you know, they locked down, and with the lockdown, they weren't buying a lot of our goods too. Overall, the trade tensions at this point won't benefit us as we try to move forward. And, you know, Ryan talked about Cummins and their export business. I'll let him continue on in that, but we need the export business to help our economy move forward, pandemic or not.
What I would argue as well is this is a political year, and so I think that there are political tensions between the United States and some other countries that maybe we historically haven't had in the past. And my guess is, because this is a political year, some of those countries that you're referring to in the European Union may kind of wait and see what the results, if we in fact have an election on November 3rd. Is that the date? I think it's November 3rd. If we have that date election, I think some of those countries will wait and see what they want to do with the relationship with us. But you know, certainly one issue that pops to mind is the question of developing vaccines and therapeutics, and how well we articulate that synergy as a world. It could only help shorten that timeline. So I'm hoping that we do repair some of those relationships.
All right, thank you. Here's a couple from the chat. Any worries about things getting so bad that the government pensions or Medicare will be affected?
Steve, I don't know which one of these, or if any of them you want to take.
Quickly, I would say no. You know, you look back to the Great Recession, and it did not negatively impact the pensions, the other funds, the social programs. More than the GDP and how the economy is moving, we have to be concerned with that debt side. Sooner or later, that comes due. If they're not taking in enough revenue to pay all these bills, sooner or later, I saw another question, that will have a drag on the economy. And some of those bills are the social safety net programs. If you're talking near term, the next year or two, and this is my speculation, I don't see that having a negative influence for those who are retired. I don't think it changes the picture long term for those social programs. They're in dire straits sooner or later. Ryan?
What I would say is that this is a pick your poison, lesser of two evils kind of a situation. So right now, the more urgent fire is the short-term element, the unemployed, the short-term loans coming due, and calls on those loans with small businesses, mortgages, things like that. So we have to do the fiscal stimulus right now to prevent the fire from getting so big that it potentially upsets most of the apple cart. So the long run is, of course, there will be more debt added to the tab. And then Steve just got into, certain elements of when we get there, when the fire is put out, we'll look at the damage and do damage control at that time. And there are a variety of different ways that they can go about handling that.
Thank you. Here's the next question. Will the debt the nation incurs today be a headwind in the coming quarters despite a nice recovery? What would those headwinds look like? Increased lending rates, taxes, etc.?
Yeah, I mean, I think we just kind of addressed that question with the previous question. With respect to government expenditure and government revenues, and of course, one line item in that government expenditure is the interest tab. And so we're basically just consuming now, and we'll have to pay for it later, but it's an urgent need to get this fire under control.
To reignite the economy.
All right, thank you. Does your research show the quantity of international travelers coming to the U.S. and what percentage is that travel?
I do not have any data on that, and that is not an area that I went into in any depth.
Let me just say this, Steve. That's a great question. I think there's a lot of great questions that we're not going to be able to answer today, and that's one of them. There could be some good data on that. Part of the problem with this is there's so much data, and it's so turbulent and dynamic and changing. I think many of you might remember. I don't remember when this was, Steve. It was in May, I think, where an initial jobs report was expected to be negative, and it was a positive 2.4 million. Huge surprise. So I think we're going to see surprises and revisions going forward for a long time. So number one, the data isn't there. The data's murky. And secondly, I just didn't look at that, but that's a good question.
And I would even extend that question. Will this have implications for international travel for a longer period of time? We've become accustomed now to not traveling. We've become accustomed to using Zoom or other avenues, and business can save significant dollars by having meetings through Zoom. I believe my brother's on this call, and he indicated to me when he was traveling to China that the costs could be upwards $10,000 a trip. Tell a business that I can save you $10,000 by keeping people home and letting them use Zoom. Fairly significant savings. So how will this impact international travel longer term? I think the airlines are really concerned at this point.
Thank you. Here's another one. You noted that many rural areas have lower unemployment. Do you think this is due to the outsized role that local and state governments play in employment? Without federal assistance for state and local governments, will employment start to fall in those areas as well?
At least the data I looked at for the counties around us, they were influenced more than Bartholomew County. So Decatur, Jackson, Jennings, Shelby, they had a higher unemployment rate, and it didn't rebound as quickly. Obviously, it's on a smaller population, but I guess I didn't see where they weren't influenced as much. Keep in mind, agriculture isn't a big part of even Indiana's economy anymore. We're manufacturing, we're hospitality, we're finance, those areas. So, Decatur, Shelby, Jackson County still haven't recovered to the level that Bartholomew County and Indianapolis has.
I would add to that. I think his question has merit. I think there would be an effect based on the mix of employment in a urban area versus a rural area. I think that with a rural area, you're going to have more government employees per capita just because of that fixed cost. It might not be that big of an effect, though. It's a good question. I haven't looked at it either, but I suspect it would have an effect. I think that largely what I thought was true about it was that if you had a retirement community, or so far a college town, they're okay. And otherwise, if there was a more agrarian, self-sustaining type of community, food is not going to go out of style tomorrow. So they're doing okay where they're growing food. They're doing okay where there's retirement communities. And thus far, and God help us all if it doesn't work out, but thus far, college towns are doing okay as well. And all that innovation that comes from that, hopefully will continue to be sustained so that we can drive some future growth and progress as we move forward. But I think that I think it's an interesting question. I think that there would be a little bit of an effect with government employees. I think that probably is true. I just don't think it's very much.
All right. Well, I want to say thank you to Dr. Mohler and Dr. Brewer for taking the time to share this valuable information today, and for all of the attendees for taking the time to learn more about this important topic. Please consider adding our annual Outlook panel to your calendars. It will be on November 17th. More details about the format will come as we approach the event date. Our next timely topic event is a week from today. Privacy in the Digital Age will occur at noon on August 12th. The event will address the challenges, issues, and concerns regarding data privacy. We will discuss the implications of sacrificing data privacy and possible actions that can help people work toward the goal of regaining some data privacy. The event is free, but like today's event, you must register to attend. Finally, if you know of anyone who is considered attending IUPUC in the fall, please know that our programs are accepting applications through the first week of classes, and to connect with IUPUC admissions for more specific information. Thank you for attending today. We hope that everyone stays safe, and we hope to see you at the next Timely Topics event.